Hi, I'm Steve Van Meter, macro fund manager and inventor of Portfolio Shield, and I'm joined today by inflation expert Michael Ashton. With inflation being such a hot topic, I had to get Mike on the show to take a deep dive into the world of inflation and address some of the misconceptions about it. Mike, thanks for joining me today.
Hey, Steve, it's great to be here.
So, Mike, for those who aren't familiar with you, can you tell us a little bit about who you are and what you do at Enduring Investments?
Sure. So I've been called in the media occasionally an inflation nerd. And in the past, when I was called nerd in different contexts, that wasn't quite as complimentary. But I think inflation nerd I can own. I'll let the viewers make that decision after an hour or so. But before I was an inflation nerd, I spent a lot of time on Wall Street working for big banks like J.P. Morgan and Bankers Trust, Barclays, and folks like that, doing the trading thing. I traded options for a while, and then I traded inflation derivatives back when that market really started. And that's when I started to become the inflation nerd. It was back then. And then I left the street because most of the interesting problems in inflation require innovation, and Wall Street is not great at innovation. So I founded Enduring Investments about a decade ago, and Enduring is an investment management firm that focuses on innovation in inflation space. So we don't run big portfolios of vanilla tips, but we work with high quality partners like M plus funds or simplify ETFs, real asset strategies, to produce unique inflation related strategies, and also individual clients and corporations as well. And so the way I sort of like to summarize Enduring is that, if you think about your house and something goes wrong in your house, something generic, then you call a handyman. And so there are lots of investments handymen out there, they can sell you a nice broad portfolio of something. If the pipes break over your bed, then you call the plumber. And so we're inflation plumbers. If there's, something's broken, you need a hedge for college tuition inflation, then you can't call the handyman. You got to call the inflation plumbers. And so that's what Enduring does.
Excellent. Well, I think what I'd like to start out is a lot of people have a misconception about what inflation is. So can you tell us, what inflation is and how do we measure it?
Yeah. So, what inflation is it's really, it describes how your dollar buys less over time. And I'm going to talk in terms of dollars because I'm in the United States, but true anywhere, obviously. And so, the way we look at that is from a price perspective, right? So the number of dollars per apple is just the inverse of the number of apples per dollar. And so we look at this in terms of price indices. But that's what we're really looking at is how the amount of money you have buys less over time. That's inflation.
So how do we measure it? I mean, I think we're all familiar with the consumer price index or the CPI, but I don't think people really truly understand it. So maybe you can walk us through that.
Sure. So the CPI is a consumption weighted index. And what we're trying to do is say, if you've got a basket of goods and if you're an average consumer and you buy this average basket of goods with your dollars, how many more or fewer baskets can you buy every year? Usually fewer. And so that's how the CPI is constructed. It's a consumption weighted index. And, it used to be that they would send out people with...
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1. I don't think you can afford to be without it.
Usually fewer. And so that's how the CPI is constructed. It's a consumption weighted index. And, it used to be that they would send out people with clipboards. Now they're iPads, and a lot of it's done electronically or by phone interviews. And they measure the prices of all kinds of stuff. There's 280 something different categories that the Bureau of Labor Statistics reports. People seem to think that there's just one CPI number, and it all aggregates up into that one number. But if you want to dive deep, there's a lot down there, and so the inflation nerds can get pretty dirty with some of those numbers over time. So they measure all those things, and they aggregate them up according to the consumption weight. And so if you buy almost nothing of something, then it doesn't really matter what its price does. It doesn't affect how far your wages go. If you buy a lot of something, then it matters a lot more, and so it should be weighted more heavily.
So is that really why they do a consumption weight instead of maybe some other form?
Yeah, obviously everybody consumes something different. Your basket is, and by the way, it's different demographically. I know some people were asking last night on Twitter, about whether or not you could have different baskets for retirees or different demographics. The BLS reports them for different cities, metropolitan standard areas, so you can get the CPI for Chicago and things like that. And so the answer is, yeah, you can. And in fact, actually on our website, we have a neat little tool that allows you to kind of adjust the weights for your basket a little bit and see what your price index might do. But what you care about is the total amount of things that you buy. So you can look at the price of any one thing you buy, and it's kind of interesting and exciting. But if some stuff is going up and some stuff is going down, it's the aggregate thing that you care about. That's why consumption is sort of the right way, as opposed to equal weight or what have you.
So, someone who's maybe younger, has a family, is consuming more, you would say they're going to feel the effects of inflation versus, say, someone maybe in their 80s who really isn't consuming that much.
Yeah, but over whatever the size of their basket is. So that you're right, the basket size changes, but they also consume different things, right? So the retiree is traveling more and not consuming very much education. Whereas the parent, new children, cares a lot about college tuition inflation and medical care in the long run and things like that, things that are going to affect their retirement. And maybe they don't care as much about travel right now, or they don't, they buy lots of new clothes for infants. That kind of matters, right? So again, the baskets can differ. We actually did a project recently. We developed a hedge for Quebec retiree inflation. Same kind of thing. Retirees in Quebec don't consume the same things as college students in Manitoba. And so, the generic Canadian index isn't necessarily the right thing. So, yeah, so you can put those baskets together in a lot of different ways.
Cool. And I want to talk at some point, but not, we'll get to it, on the effects that COVID's had on consumption. But before we get to that, let's talk about the accuracy of the CPI, because something I hear all the time is, Steve, the CPI, it doesn't really apply to me. I see inflation all the time. I don't know where you live or what stores you go to, but you seem to think that some prices go down. It's not realistic. Is a CPI, is it accurate? Does it omit things? I mean, what's going on?
It's really interesting, because as long as I've been an inflation guy, that's the question you get all the time. And it really, a lot of it has to do with sort of cognitive biases and cognitive errors that we make. If you look at the unemployment rate, okay, how do you viscerally get an idea of what the unemployment rate is? Well, you look at how many people around you don't have jobs. And so that's pretty easy to get a good sense of. CPI is much harder to get a sense of inflation, because you buy thousands of things over a long period of time. And so you notice certain things more than other things. And so in particular, you buy, the stuff you buy every day, you go buy something at Starbucks, you'll notice if the price of that latte goes up. But unless it goes up a whole lot, it doesn't really affect your overall inflation that much, but you notice it. It turns out that if you survey people's expectations of inflation, it's really highly correlated to gasoline, because people buy gasoline a lot. It moves a lot. And so because of this, you have these cognitive biases have lots of really interesting opportunities to work on your perception of inflation. So you tend to think of, so that you have this loss aversion thing that you tend to notice when prices go up because it hurts, and you attribute that to inflation. And when prices go down, you attribute that to good shopping. So gasoline is a great example, right? So if you ask people, what are gasoline prices like? 9 times out of 10 people, and you say, well, how high are they compared to 5 years ago? Almost everybody, your gut reaction is gas prices are much higher. That's absurd. They've been going down for 15 years. I mean, gasoline prices are now, if you go back and you look at a long-term chart, it's low. It's not high. That's not the way it feels, because you don't notice it as much when it goes down. You notice it every time it goes up, you notice it again. And so because there are all these opportunities for cognitive biases to work in inflation, and that's why. So I haven't really answered your original question, which is the CPI accurate? So I may get to that. But because of this, we have this sense that it's really high, and all the surveys always come up with a set. The belief in inflation is always higher than the actual measured inflation. But is the measurement right? And the answer to that is I think yes. And there's lots of sort of ways that we can measure that. And let me back that off just a little bit. Yes, it's kind of accurate. I mean, it can't be perfectly accurate. There's lots of things that are wrong with CPI, but they're not really big things. If they're really big things, then over a long period of time, we'd really, really notice.
Yeah, because I track my budget, and I don't know if a lot of people do that. And again, I think as you and I have talked before the show, I get accused, and maybe you do too, that I live in some deflationary world, but maybe it's because I can say that my cell phone service has improved and the prices maybe gone up or even gone down, or I'm getting ready to lease another car, and I really like EVs because I got a massive amount of solar panels on my house, and there's a lot of tax credit for them. And I'm noticing that the same car I leased 3 years ago is cheaper, but yet everyone tells me, prices go up. So is the inflation that we're seeing in the CPI really affecting the average person, or maybe I live in a special spot that's deflationary?
Look, I mean, again, everybody's basket is different. I think that in general, one of the things that we do to CPI is we want to measure a constant standard of living, and this ticks people off to no end, right? That if you buy a computer 4 years from now and it has the same price, it's cheaper in CPI terms because it's a lot more valuable of a computer. And people will argue about this all day. It turns out that those hedonic adjustments net add to zero, because there's a hedonic adjustment to housing that works the other way. So it kind of nets out to nothing, but boy, does it get people irritated. And it's a fun topic in and of itself. But I think overall, I think that you're talking about inflation according to the CPI of around 2. And again, you're buying thousands and thousands of things. Is it plausible that you could have a minus, especially when you include things like gasoline and so on, and someone else might have a positive? Yeah, I mean, that's clearly within the range, the normal range, person to person, right? There's lots of different things, and your basket is clearly different than someone else's basket. We also include things in our own personal budgets that aren't really inflation in terms of they're not consumption, like taxes, although those aren't going down. So you're not getting deflation from taxes.
Well, I think we all wish we were, but that's probably unlikely to happen.
I think it's a different. That's maybe a different conversation.
Yeah, I think it definitely is. One thing I hear is, the CPI can't be accurate because it doesn't include, home prices, college tuition, and stock prices. And you said earlier that it covers 280 things. And whenever someone says, it doesn't have this, I go onto the website and I'm always amazed at how much it really, the government tries to do. But why don't we have, say, housing prices? Because didn't they used to be in the CPI? And is there some reason they've removed that?
Oh, it's nefarious. It's very nefarious. Back in the early 80s, so the BLS is they make little changes from now and then. They don't make many big changes. They occasionally make a big change, but it's usually after a whole lot of study. And so, a long time ago, they used to use housing prices or mortgages, things like that. And what they decided to do is they settled back in the early 80s, and this will get to something else that I'm sure we're going to talk about later, some of the alternative indices, that the rental equivalence method was the right thing to use for housing. And the reasoning is, and it's pretty solid from an economic standpoint, and that is that when you own a home, you own really you own a home for two reasons. One is to live in it, and the other is that it's an asset and it goes up in value. Sometimes it goes down, but it's, you own it as an asset. And so, when the price of the house goes up next month, or over the next 5 years, and what does that do to your cost of living in the house? Does it do anything? Does it do a little? Well, from an economic standpoint, if the, what could you do as alternative shelter? You could go out and rent a place. In fact, you could, if you wanted to own your home as just an investment, you could move out of it, rent it to someone else, and with that money, go and rent a place of your own. You'd have exactly the same situation. You'd own the price appreciation of your home, and you'd be living in an apartment. Okay, but then it would be really clear that what you were paying was for shelter, was rent. Primary rents is what we would call it. And so that's what the BLS did with housing. And so when you get these big bubbles like we did in 2007, you see that rents go up, but it didn't go directly into the CPI, because a lot of that, if you look at housing prices compared to wages, for example, it's very clear that it was a bubble in the asset price value of it and not in the cost of shelter.
That's really interesting because, you think about asset prices, or when I do, I don't look at buying a home every month. Now, maybe there's some people that do, but they're investors. They're not buying it as consumption. And I think that's a clear point that you're making. The consumer price index is trying to gauge consumption. We don't consume stocks. We invest in them. We buy houses for shelter. We don't consume them. And so what it's trying to do, if I'm understanding you correctly, is just figure out what the average American is going to need, or their cost of living is going to increase or decrease on a month-to-month and year-over-year basis. Is that kind of about right?
Yeah, that's right. I mean, it's the BLS will tell you it's not a true cost of living index for all kinds of weird economics reasons, but it's pretty close. It's close to that. When Tesla goes up, that doesn't really affect your cost of living. It means you get to buy less Tesla, but that's the cost of a Tesla goes up, then that might affect your cost of living. Not mine, mind you, but it might affect yours, Steve.
Right.
And that's why we don't include stocks, is that, asset prices going up it's inflation in some sense, that it's devaluing the dollar in some way. You can buy less investments with it. So it's inflation in that sense, but it's not inflation in terms of your cost of living. If IBM goes up or down, is there still an IBM? If Tesla goes up or down, or it doesn't really affect how much it costs me to live in my house or how much it costs me to buy gasoline.
So, one criticism of the CPI I've known you've heard, is that this thing is highly manipulated. The BLS and the Fed and other government agencies are all in cahoots to suppress the cost of living so the Fed can maintain an easy monetary policy. Any truth to that?
I haven't been a big conspiracy theorist in the past. I got to say that over the last year, you're starting to get a little bit, there's a little more reason to sort of be worried about conspiracy theories. But, in some ways, look, I don't trust the government. I will say, though, that the BLS, it's run by lifers. It's run by economists, the pocket protector set, and they're very serious and thoughtful in public about how it is they go about building and they debate these things endlessly, as to, how to build these indices. But there's lots of independent ways that we can look too. So there's this MIT there's this gentleman at MIT that created this thing called the Billion Prices Project. Now State Street owns it, and it's called Price Stats. And it basically is a web scraper. It goes out and scrapes prices for an entire consumption basket. And it, by the way, it can do this in all kinds of countries, and it creates its own price index. Well, it turns out that price index is pretty close to what the BLS comes up with. In fact, some hedge funds will actually subscribe to Price Stats because they think that they might get an early read on what's going to happen when the CPI comes out. And so you can see, for example, the difference between the official statistics in Argentina and the Price Stats number is huge, okay, because they do make it up in Argentina. But in most countries, it's pretty close. And in the US, it's very close.
Well, that's good to hear that, that the CPI is accurate, because, we hear all the time that it just doesn't represent people, but it sounds to me that they do a really good job, and I'm glad to hear that. So,
well, look, I mean, let me throw some caveats on there though, because it doesn't do things perfectly, right? So, I mean, there are things it misses. It doesn't do intellectual property. It doesn't handle very well. I've got a friend who is ex chief economist at Bankers Trust from years ago. I won't tell you how many years ago in case he's listening. He insists that, and it's a good point, that because we don't have intellectual property, and yet we have we have a lot more technology and intellectual property sorts of things in our economy now, that, he insists that inflation is really lots lower than we think it is, and growth is a lot higher. So, we always get in these debates about whether or not CPI is off by 1 or 2% one way or another. CPI may well be up, and we don't measure. Medical care is very difficult to measure. There's various things that are difficult to measure, and we may or may not do it the right way. So CPI, it might be off, and occasionally somebody, some commission will say it's off by 0.5% or 0.25% one way or the other, or maybe sometimes it's off by 1% one way and then it swings around, it's off 1% another way. But over time, on average, I think the CPI it certainly isn't, let's put it this way, there's no conspiracy. If it's off for honest reasons, which, happens.
I would say, but over the long term, I'm not going to notice 0.2% difference. I mean, and as you said, there's no perfect way to measure it, but this is pretty darn good, which then is going to bring me, as I'm sure you're guessing where we're going next is.
I hope you're going where I'm thinking you're going.
Yes. There's some alternative indexes out there. Everyone says these are the real deal. We've got Shadowstats, Chapwood Index. I know everyone's dying to hear what you think about them.
Sure. Well, let me deal with the Shadowstats first, because that's the one I've been hearing about and talking about for years, it seems. So Shadowstats' basic argument, the biggest piece of their argument, was that the BLS, the CPI, is way low, like an order of 5 or 6% too low, because of various changes that the BLS has made. But the big one being in 1982, when they went to the rental equivalence method for shelter. And according to the Shadowstats boneheads, they say that's worth 5% forever or whatever. And look, maybe over the first 2 years they could make that argument and get away with it. We've already talked about how perception always is that there's higher inflation, so it's easy to sell that story, right? But over a long period of time, it can't possibly be the case, and it's offensive to mathematics that they can still make this case. And this is why, I'm sorry, I'll start to get agitated here, and so I'm going to try to tone it down a little bit. But the math is very compelling. The power of compounding is magic, right? So let's think back to 1982, and let's suppose we have somebody just coming out of college, and they're making, $20,000 a year. I don't remember exactly what they were making, but that's not ridiculously wrong. And let's suppose they came out and their standard of living was $20,000. So came out of college, barely scraping by. I remember something like that. Okay, so according to the average hourly earnings, that the wage number should have roughly tripled over that time period. So college student now is making high 50s, low 60s. I don't know what they're making right now. That sounds a little high to me, but it's not way off. They're not making like 200,000, and they're not making 10, right? So, we have a visceral feeling that number is not too far. The CP, and so that's 3% a year compounded growth. The CPI over that time period has compounded 2.6%. And so that standard of living that in 1982 is now cost you 53. So you're doing a little bit better than scrape and bottom.
Yeah.
Now, if you use 8%, as your Shadowstats says it's something like 8%, that $20,000 standard of living now costs $360,000. And so if before you had to share an apartment with, so that's, you now can afford 1/6 of your former basket. So that apartment that you used to share with one other person, you now have to share with 6 other people. That car that you're sharing with 3 buddies in 1982, now you share with 18. That's absurd. That's absolutely crazy. We'd kind of notice if that were the case. You could not live on a graduate salary anywhere close to what you used to live. And I'd argue that you live a little bit better. So that number can't possibly be right. And I think that that's conclusive proof. Doesn't mean CPI is exactly right, but that's a heck of a lot closer just intuitively, right? So anyway, that's Shadowstats. And there's other things you can argue with Shadowstats, like, if inflation's really at 8, it means that the trillions of dollars of bonds, the trillions of dollars of stocks, they're all totally mispriced. People have been taking these deeply negative real yields. Somebody who's been investing for 40 years should be roughly even. Their portfolio has gone up, but just about the cost of living. And so they're no richer now than they were. Well, if you know anyone who's been investing for 40 years in stocks and bonds, they're doing okay.
Yeah.
Right. So, there's lots of intuition there that, again, the compounding makes it really obvious when you're off by a lot.
Yeah, and I think off air you mentioned housing prices, how that would compound, and that we'd all be living in cardboard boxes. Can you kind of expand a little bit upon that? And I think that really helps drive this view home on Shadowstats.
Yeah, same thing. So if we look back, and again, we've had 2 housing, one housing bubble in 2007 and arguably one right now relative to wages. But for a long time, housing relative to wages was a straight line. I mean, housing went up, close to 1-to-1 with wages. And actually, Bob Schiller has pointed out that housing over a really long period of time has gone up almost exactly the same as inflation. How do you know? Because we have prices from the Netherlands on housing going back to the 1500s. And if the prices of those houses had compounded at anything other than the price level, they'd be, worth trillions of dollars now. They're not. So we know it's got to be pretty close to zero. So housing tends to go up pretty close to overall inflation over a long period of time. Again, we're kind of in a bubble now. Well, again, we sort of know what housing prices have done over this time period, and they have roughly tripled or a little more than tripled since the early 80s. And if the price index has gone up 6 times more, then we all be living in cardboard boxes. The house that you could have bought for $100,000 back in 1982 is now what, 3.6 million or something, something like that. That's not the case.
Well, yeah, we know the median house price is not 3.6 million or anywhere close to that.
It's not. We wouldn't be able to afford housing, right?
So take us through the Chapwood Index, and that's something I'm not overly familiar with because I hear a lot about Shadowstats. So for the uninformed like me, what's the Chapwood Index and how does it compare?
So the Chapwood Index, it's an interesting idea, and the idea is let's just ask people what they spend on things, and so we're going to crowdsource this, but because we're crowdsourcing it, we can't be super. We want to be specific about the products, but we can't have anything that's really hard for a lot of people to get, and so it ends up having a lot of things like movie ticket, Starbucks, gallon of gas, whatever. So it's got a bunch of different things that are fairly easy to measure, but all really small. And do they weight them by the quantity that is consumed? No, they kind of equal weight them. But which means that over time it becomes price weighted. The things that go up the most in price end up having the biggest. So if if the cost of diapers, I saw diapers is in there. If the cost of diapers goes up, faster than everything else, then most of the Chapwood Index will become the price of diapers, which is not really intuitive to me. And so, but it goes back to one of the reasons that the Chapwood Index is appealing to people, goes back to those cognitive biases, right? Those are things we buy every day, right? Yeah. And so we do record those things in our minds. We notice those things. And so those numbers are right. There's no question they're inputs. That when they have the price of a Starbucks cup of coffee, no question their number is right. The way they put it together doesn't look anything like consumption. And it doesn't look anything like our overall market basket. So it's not super helpful to me. For that small basket of things, it's, I guess it's kind of useful, but I don't know anyone who happens to buy just those things. And if you add them all up, it's still a tiny amount. I mean, it doesn't really have any, I don't think, I haven't looked at the whole, I don't think the, refrigerators or washer dryers are in there. We don't buy those every day. We don't buy them every year, if you're lucky. But they're, on average, that's a big purchase, right? So it does matter when those things don't go up in price over a long period of time, and that doesn't show up in the Chapwood Index at all.
Well, that's really interesting. So let's shift gears a little bit. So we've got this we've got Shadowstats, which, looks like it runs really hot. Chapwood, which focuses more on probably I'd say my daily consumption. But yet we can now turn to something like the University of Michigan survey. We see expectations falling, yet the stock market is saying that inflation is just about to, launch like a rocket. What gives with that?
I mean, it's again, the surveys are heavily driven. It's actually really interesting that, and actually the Purchasing Managers Index, the PMI, has a price index in there as well. And all of these indices are highly correlated to gasoline, because again, it's the thing that you see every day. I think that sounds like a Silence of the Lambs thing, but I'm not really going there. I mean, but we covet the things we see every day, and we price them too. And so that's what shows up in the surveys. And again, the cognitive biases tend to make it higher. So what's happened to gasoline prices recently? They've kind of gone down. But what is sort of interesting, though, is if you plot those two next to each other, you have started to see, like in the Purchasing Managers Index, you have started to see a divergence. The Purchasing Managers Prices Paid Index has, in fact, started to diverge from the price of energy on the high side. And so, there's some indication that there's some price pressures outside of just those basic things that affect those main surveys. By the way, years ago, I wrote a paper about all these cognitive biases that was in the NABE journal. And I built an index that was supposed to be like the real feel. So, like temperature, right? How cold is it outside? There's the thermometer, tells you precisely how cold it is outside. And then they give you the real feel, which is, well, but the wind is blowing. It feels colder than that. Which one do you care about when you're going to go decide what to get dressed in? Well, you care about real feel. And so I tried to make a real feel inflation index that corrected for a lot of those biases. And that's interesting as well. It turns out to be much more predictive of, say, what's happening to gold over time, because that drives investor behavior a lot more than what the CPI index is doing.
Yeah, and I definitely want to talk about gold at some point and get a feel for maybe, what you look at in the CPI to maybe predict its direction. But before we get there, I want to touch on a really touchy monetary subject, the money supply. So March 2019 or 2020, the year-over-year rate of change of the money supply shoots up something like 25%. Next thing you know, everybody is screaming, inflation is here, inflation is coming. We're 2.5 months away from a year now seeing that. The CPI is not back where it was at pre-pandemic levels. In fact, it looks like it's kind of rolling over. And I know when this interview airs, we'll actually have the print, so we don't know that today. Is this real? I mean, are we about to see inflation just skyrocket, or is the relationship between the CPI and the M2 old news?
I'm sorry to tell you that in the long run, it's money that matters. And so what happens though, there's two things that this is strict monetarist, right? So people spend a lot of time talking about the output gap. I always tell them, if the output gap mattered, then we don't get inflation in the 1970s. Okay, so it's money that matters. Now, it's money and velocity that matters, right? So the velocity of money is how many times does that dollar get spent. And so, and by the way, it is things like M2 or M1 transactional money that matters, and not bank reserves. So the big mistake we made say a lot of people made back in the GFC was, they looked at bank reserves. Bank reserves went up huge, right? The money base. But M2 never accelerated a whole lot because banks sat on that money.
Right.
So, and the money velocity dropped because one of the things which drives money velocity is interest rates. So let me draw that intuition for you, because sometimes people are a little fuzzy. I think back when we were in school, they said, let's assume a velocity is stable, which is the worst possible assumption you can make. But, and they never really talked about what drives money velocity. But the main thing that drives money velocity turns out to be interest rates. And there's uncertainty in various other things, but the main thing is interest rates. And it works this way. If interest rates are very low, then, or if interest rates are very high, then you're going to want to, then there's velocity is the inverse of the demand for real cash balances. So you'll hold more in cash, right, when that happens. As interest rates go down and down and down and down, the penalty for sitting in cash as opposed to investing in something goes down. So if interest rates are 8% and your bank account is earning 0, you have cash in there, what do? Well, you either spend that money or you go and you buy an 8% bond and you give it to a bondholder, and then that bondholder goes and spends it and so on. So the money speeds up, right? With interest rates are at 0, whatever, I'll keep it in the bank, right? And so lots of people do keep big cash balances. Corporations keep big cash balances because there's really no penalty to do it. And so as interest rates go down, so does money velocity. Okay. So what happened this time around? It was even bigger than that. So people also hold precautionary cash balances. What other reason do you hold cash for? Well, if you're worried about stuff, things are going bad, right? Then you're going to hold a little more cash. And there was stuff going real bad over the summer, and all of a sudden the government dropped cash into people's bank accounts. Guess what? They didn't spend it. Okay, and so that's what matters is. And by the way, they couldn't spend it on a lot of products; they weren't available. When they did go out and spend it, we saw this jump in CPI. The core CPI went up 0.6 1 month, then 0.4 the next month, and then it was negative. So the short answer is that money growth, unless the Fed somehow pulls it all back, in which case bad things are going to happen elsewhere. It's got to go somewhere. And it either is going to sit forever in great big cash balances that nobody will spend. I'm a little skeptical about that, or it gets spent. And if it gets spent, of course, part of it is it's going into stocks, because when you're sitting around, you can't go out and go to a restaurant. What do? Well, you buy stocks because you can do that online. And that's part of what's happening with the cash. But once you can go out and buy things again, people will spend. And once those things are available, like if you go out and you try to buy a puppy right now, it's harder. The price of a puppy is going up a ton. If you try to buy a jacuzzi or even a used car, they're hard. Those prices have gone up a lot because they're hard to get. So when those things become available, when things go back to normal, money velocity will return, but the amount of money ain't going away, and that's when you get the inflation. And I think it's going to be this in 2021.
That's really interesting. I've never heard someone say the penalty for holding money at 0 interest rates is 0. There is no penalty. And that's really interesting, because as we talk about monetary policy here and its effects on inflation, the Fed is got the Fed funds rate pinned at 0. Likely, maybe in our lifetimes it won't go up. I don't know. It just seems impossible. They're doing all this quantitative easing, increasing the monetary base. And they seem to be only successful about talking about inflation because they've got rates pinned so low. Is it possible that monetary policy is going to lead to inflation, or do you see further disinflation from the Fed's actions?
So this is the $64,000 question, but unfortunately, so the real question is, though, we had money growth for a long time. But look, we had money growth for a long time of 6, 7, 8%, which is higher than you would expect. Mm-hmm. But you had interest rates coming down, and so you had money velocity coming down. And you have this big money creation, and you had money velocity plunging. But the problem is, once you get to zero interest rates, it's kind of hard to keep it plunging. And so, right, and so you can only go to zero once. Now, we could go negative, and if we ever get central bank digital currencies, you might end up with deeply negative real rate, nominal rates. So you could get slightly negative nominal rates, but at some point it's hard, and it's hard to keep people scared too. So people are holding right now large precautionary balances. At some point they're going to not be scared anymore, and once people stop being scared, money velocity goes back up. And so it's you can get velocity down, but it has to keep going down, and there is some limit. Money velocity isn't going to go below 1, right? The money gets spent once a year, so there is some kind of natural floor to it, and once we reach that floor, then any money growth goes right into PQ. So,
well, that's really interesting. It would be odd to have a money velocity of sub-zero. Sub 1. I think we'd all be pretty baffled by that. And you're right. There is a point where it does get low enough. Now we don't know what that is yet, that money will come out. So is a solution. Now we heard today, President-elect Biden said there's going to be trillions of stimulus coming, more stimulus. And now we've got this belief that, okay, the M2 hasn't led to inflation. The Fed hasn't been able to create inflation. A full economy is not leading to inflation. But the magic elixir is fiscal plus monetary stimulus. Is that what we've been looking for all these years?
That's MMT, right? Modern monetary theory says spend a whole lot of money and print to do so. A magic money tree is that's how I like to, that's what I've heard is a good for the MMT abbreviation, magic money tree. Just print what we're going to spend. Well, first of all, if that works, then everybody for the last 200 years is an idiot. We should have been doing this for a long time, right? It's perpetual motion, right? It's just like, let's just keep printing money and spending it. Wow, we should have thought of that a long time ago. We've tried that before and it didn't really work out. So, the money drops, and the printing, and it's all. That's what we did over the summer, and you did see, you got when you could buy anything. You did get a really sharp jump up in core CPI, and then partial lockdowns again and whatever. It'll happen, and having big fiscal spending, dropping money directly, and again, central bank digital currencies could do that directly too. Then the Fed could drop money directly into your account, and then charge you a negative interest rate, so you have to spend it. And then really bad things happen. So look, again, if this doesn't cause inflation, then we should have been doing a lot more of it for a long time. But then it gets hard to explain when we did this in the 70s, why did that lead to inflation?
Yeah,
because we did try this before. It has been done, and it wasn't even close to. It was actually orders of magnitude less than what we're doing. So, it's I don't. We will certainly see, but I think I know which way I feel the bed is going to go. Again, it doesn't. It's not. Next month probably, but I feel fairly confident that's going to happen over some. And I don't. We're not talking. In the long run, we're all dead things. We're talking about when we're all mostly going to be alive.
Yeah. Well, and we've seen Japan struggle with this. They've done a ton of, MMT style, and it hasn't gone anywhere. It is perhaps, is COVID really the problem here? Is maybe there is a lot of inflation. Maybe money does really want to move, but it can't. Do you see, what impacts are you seeing that COVID has? And if we all are vaccinated, is that all of a sudden going to change the dynamics in your view?
Yeah, so let me talk first about Japan for a second, because I think that Japan is so interesting. everybody says it was because everyone got old in Japan that's the reason that they didn't have inflation. But if you go back and you look at their M2 growth from basically when they went into deflation until a year ago, it was like 2% money growth. I mean, they didn't grow the money supply. That's the reason they were in deflation. And then they briefly started trying to, they started trying to print money, buy lots of assets and increase the money supply. And they started to do that, and inflation started to go up. And then they went to zero interest rate policy and stopped worrying about the quantity of money, and they kind of slipped back down. But now they're back up. What's COVID doing? So yeah, COVID is it's doing two things. One is it's keeping us from spending the money, from going out and spending it. And restaurants is kind of the classic example. And there's lots of, hotels, airfares, all those things. I mean, there's lots of things that you just can't spend, or very, very difficult to spend. But it's also affecting the supply side. As I said, you can't get a lot of things. It's affected the movement of containers, container prices. So, imports are, I think a lot of us experience long delays over the Christmas season trying to get something delivered a lot of times because it had to come from a long way away, and it's kind of hard. The shipping is going up and it's very expensive and so on. There's a lot. Those are at some level they're short-term effects, right? I mean, some of these things, there's some things where the long run supply will be affected. I don't know that we will ever crowd into movie theaters, in quite the same way. And so probably a lot of movie theaters will go out of business, not to come back. I think restaurants will come back. Colleges, maybe they will never crowd people onto the campus in the same way. Maybe, they're going to try to make a lot more virtual, so some of those things are permanent. But a lot of, as life gets back to normal and things become available, remember, inflation is too much money chasing too few goods. The supply side, the good stuff, that part is eventually going to come back. The too much money, though, is also going to start to get spent. So that ratio is what determines when this happens. If people start spending the money before we're ready to start producing more meat and everything else, you already see the price of meat going up, then you'll see inflation in the short term. If our production ramps up before people are ready to spend, then you'll see disinflation first and then inflation. But I'm pretty sure eventually we're going to get to the inflation part. I personally think we're going to get inflation first, but I can certainly come up with a scenario where everyone goes back to work and no one's yet ready to spend. I can see that.
Yeah, I mean, nobody knows what consumers are going to do when they're doing it. If we knew that, we'd be pretty rich because we could predict what their activities are and invest there. So I want to talk about the dollar and how it affects the CBI, because I have a view, but we'll get to that in a second, and I want to get your opinion on it. Since March, we've obviously seen the dollar declining. I know a lot of people believe it's going to continue to plummet, but in relation to the CPI, the weak dollar has helped push, or at least in my view, has helped push the CPI up. If we see a big dollar rally, is that a big negative for the CPI, or what I'm seeing in the relationship just maybe really isn't there?
No, that's true. There's definitely, the price of imports, especially energy, but let's even stripping out energy, there's no question. In fact, back when Trump was elected, my fear about inflation under a Trump administration was mostly that, if you made it more difficult, if you made it more difficult to have international trade, then you drive up the overall cost of goods. The dollar, to me, and I don't forecast the dollar, I'm really bad at it. Over a long period of time, I think that, countries that print more money tend to have than other countries tend to have their currencies weakened. And so for many years, the peso is weakened relative to the dollar, but now the Fed is printing more money. And so the dollar is starting to weaken relative to the peso. But that's a long run thing. I don't have any idea of the short run. The way I think about it is that you have this global inflation, right? There's a global amount of money, and not just dollars, but all kinds of money out there. And that kind of raises or lowers the global price level. And then how that gets divided up has to do with currencies. So if my currency is strengthening, then I'm exporting inflation to you. Okay. prices are going down for me relative to prices for you. And if my currency is weakening, then I'm getting the inflation and you're getting the disinflation. But if the overall level of prices is going up, we're both having inflation. It's just that, if I have a strong currency, mine's weaker. My inflation is lower than yours.
Yeah. So, okay, let's carry this dollar bit a little bit further, because there's a few people out there like myself who thinks we're going to face a large insolvency event. The dollar is going to become a safe haven, as it usually is. It's going to just skyrocket higher, and the CPI goes negative again like it did in the great financial crisis. Is that a possibility, or am I living in a fantasy world?
I hate to ask. I hate to say of a nice interviewer that they're living in a fantasy world. That's not a good way to get invited back. And I really want to come back. But here's what I'll say. So in the GFC, the reason inflation went negative was because oil prices went negative, or not, it didn't go negative, but energy prices went down. Outside of food and energy, prices never declined after the GFC. And if you took out housing, they didn't even slow down very much. And housing is a big part of consumption. So it turns out that in the U.S., now in Europe, different answer, but in the U.S., our import-export sector just isn't that big, particularly if you take out energy. It's 14% of the economy or something, so it's the X minus M part. And so you have to have a really big movement in the dollar. It will change import prices, but it would have to change them an awful lot to make a meaningful difference. Now, it does affect goods inflation. What we have seen for many years is goods inflation doing next to nothing because of dollar strength. Recently, with dollar weakness, goods inflation has gone actually the highest it's been in quite some time. And if the dollar turns around and strengthens, goods inflation is going to roll back over, right? Because we don't import services in the same way we import goods. It does have an effect, but the goods are only a third of the CPI, right? And so it's not going to affect the price of houses very much. And housing is 40% of the CPI. So hard to get, if you can figure out which way housing is going to go and housing inflation, it's hard to be wrong on the overall inflation picture by a lot.
So what you're saying is, in your view, there's a chance I could be right, but it's pretty slim.
I think you need a big dollar rally to get to actual deflation here. You get goods deflation. It wouldn't take a huge dollar rally, and you can get that. I think you could have goods deflation if you had a substantial dollar rally. To get overall deflation, you got to have a really big dollar rally. Wouldn't say it's impossible. No, well, after 2020, I wouldn't say anything is impossible.
Well, I think it's possible. So at least I feel good that you say there's a chance, because that's good. So as we get closer to the end here, I have to ask you, blue wave, do politicians, can they create inflation?
Well, it's interesting. Politicians can create disinflation by scaring everybody so they hold big cash balances, right? Mm-hmm. So if everyone stays nice and scared about what's going to happen and holds onto their money, then they'll actually hold down inflation. That doesn't tend to last a long time, though. You start spending lots of money, and especially if that money isn't coming, you're not taxing it and spending it, so that you and I are spending less and the government's spending more, right? If the government's just spending more and I'm still spending the same amount, so it's more money going in, and the Fed is accommodating that by printing. Yeah, you can get some pretty ugly answers out of that. When you start dropping $2,000 checks, $5,000. Gosh, Biden was talking today about trillions in stimulus. Yeah, you can get inflation out of that.
Well, we'd hope so, right? So
again, if it doesn't, then we've been doing it wrong.
Yeah, right. I mean, there's a bigger problem out there in the system that we don't know.
Absolutely.
So let me ask you this, Mike. If I'm trying to figure out where inflation is going and I want an edge, what's the subcomponent I look at that tells me it's going to increase or decrease? How do I get that?
Housing is, as I said, if you can figure out where housing is going, and by the way, you don't have to figure out where rents are going over the long term. If housing goes up, then rents are going to go there. Right now rents are softening and housing prices are accelerating. That doesn't happen forever. Housing prices keep going up, rents eventually follow. But if you can get the shelter part right, and the rest of it, again, you can't be really totally wrong. But it's a slow moving piece. And so and the market responds to faster moving pieces. So, the next thing I would think, if you can get a handle on, is a very difficult part, and that's medical care, which is a big part of the services, the non-housing services, is medical care. And that's a tough part to go figure out. The CPI doesn't measure it the way you would think that we measure it. But if you could figure that part out, it will show up eventually in CPI, and that's the part that I would try to focus on figuring out.
Well, Mike, you've given me a lot to think about, and I think our viewers are going to really enjoy this interview as much as I do. And so one thing I like to do kind of as a follow-up, because you don't know the Real Vision effect, but there's going to be a lot of questions, and I'm sure you're used to this, just being the inflation nerd, as you said, that people are going to have a lot of questions. And would you be open that maybe in a couple of weeks that you and I just sit down and I'll pick out maybe the top 10 or 15 questions from this, and then you and I can just do a one-on-one and answer those questions?
Yeah, I mean we didn't scratch the surface. And as I told you before we had this, when we talked offline, if you'll let me talk about inflation, I'll talk about inflation. So, that's it's been a long time since people really cared a lot about inflation. And only the last year or so people have started to really care. And so if you'll let me talk about it, I will talk about it with you, Steve.
Great. Well, there's no doubt we're going to want to have you back for sure. So for those who are watching, if you have a question for Mike, put it in the comments. And if you see a question that you really want to know the answer to, like it. And I'm going to go through and grab, the top questions for him, and then we're going to follow up with him later. So I know before we started, Mike, you mentioned you had some products and projects you're working on. Could you, give us a little touch on what's going on with you?
Yeah, it's just been a lot of time, as I said. I mean, we do innovation, and it's been and we spent a lot of years innovating a lot of things. And so, I mentioned 3 partners that we're dealing with right now. Simplify ETFs is a new ETF shop, does some really interesting stuff with convexity, and we're working on some products around in the commodity space for them. M Plus Funds, we're working on something which would be effectively a call option on break even. So a call option on, there's really no way to trade in a convenient way for a retail investor. I mean, an institution can buy an inflation swap, you can't. And so we're looking at developing essentially an inflation call option. Real asset strategies, we're going to be putting out actually it's already gone through the SEC, it's through registration, an ETF that is a liquid real assets strategy. So you can contact those firms and they can tell you more about those things. And we're currently looking for the right partner to do the tuition inflation hedge, which I think is just an enormous product. And we really want to make sure we find the right people there. And then there's half a dozen other things, working on bringing CPI futures back. That should happen this year. So.
Wow, that sounds really interesting. So for viewers who want to find more about you or your research, how can they follow you?
Yeah, I mean, I'm inflation_guy on Twitter. Maybe I should change that to inflation nerd, but some people get offended by that. So, or you can go enduringinvestments.com, fill out the contact form. That's sort of the easiest way. I see all those things myself, and I'll respond to that. And like I mentioned earlier, there's some interesting tools on there, build your own CPI kind of thing. So, those are probably the easiest ways.
I'm a big fan of yours. I follow you on Twitter, and I know every month when the CPI comes out, I look forward to that morning because here comes Mike, and you really break it down. And I really appreciate that and all that you do to help educate us about the area of inflation. So thanks for joining us today and taking your time to be with us.
Absolutely, Steve. Thanks very much for the invitation, and I look forward to meeting you again in a couple of weeks.
It was absolutely my pleasure. So on behalf of the entire Real Vision team, I'm Steve Van Metre. I look forward to seeing you in the comments and then following up with you in the exchange. Thanks for watching.
I hope you enjoyed this special episode of The Interview, the premier business and finance series in the world. However, this is just the tip of the iceberg. For more in-depth content and expert analysis, visit the membership link in the description to unlock a week's access for only $1. This dollar can change your life.